Well, colleagues, ladies and gentlemen, it's my pleasure now to introduce our final speaker for his public lecture. We have Rabah Arezki with us virtually. Rabah is Chief Economist and Vice President, Economic Governance and Knowledge Management at the African Development Bank and a Senior Fellow in the Middle East Initiative at Harvard's University John F. Kennedy School of Government. He also was the chief economist for the Middle East and North Africa region at the World Bank. Prior to that, he was the chief of the Commodities and Environment Unit in the Research Department at the International Monetary Fund and a non-resident fellow at the Brookings Institution. Rabah is the author and co-author of numerous academic journal publications, including the Quarterly Journal of Economics, the Economic Journal, the European Economic Review, the Journal of International Economics, among others. Rabah will give us a public lecture on the topic of, or on the question of transformation, not diversification, ? Rabah, the floor is yours.
Thank you so much for inviting me. I'm sorry I couldn't make the trip, but hopefully next time. So we are at a critical juncture. We are at the last hours of the COP26, and as you know, there is a sticking point in the final declaration regarding the financing for the adaptation, especially of the most vulnerable countries that are affected by climate change. Here for the GCC, we are in a different situation where we have rich countries which are at the forefront of the production of fossil fuel for the world economy. So a very key energy input for the world economy. They have resources to transform, but the question is going to be about incentives. And I titled this presentation transformation, not diversification, to really highlight the importance of thinking in terms of incentive structures. So it's tentative, but I try to tailor it to the theme of the event. I looked at the program. There are many very interesting papers that were presented today. I hope I will have a chance to look at them. I'm going to share my presentation now. And in a nutshell, if I can really summarize what I'm going to try and articulate, is try to really take a 10,000 feet view on what we really what this transformation is about. So this is really about the end of oil and gas, natural gas, and it's about basically jumping on the bandwagon of decarbonization and digitalization. These are the real two big trends transforming the two actually transformation of the global economy. So how do we get to the catalyst here is the end of oil. Clearly, it could last longer than what people think because of India and China, and we can debate that. But so clearly, that's the trigger. But it is not obvious that with that trigger, things are going to fall into place. There certainly is room for the GCC to really become big powerhouses in terms of renewable and in terms of big, harnessing digitalization in important way at the global level, again, with big ambition. But this would require, unlike in the case of oil, it's going to require that catalyst is not enough, and it's going to require this governance shift. And this governance shift has to do with really what these new technologies are about. They are about talent. They're really about network externalities. They are about really bottom up. So governance structure shifts are going to be essential to really harness the power of this transformation that are really affecting the global economy. So they're going to be at two levels, at the corporate governance level. Here I'm speaking about the large state-owned enterprise that are really running the show, but they're running the show in an island type of economy. So they're going to have to transform, and we're going to debate how. And but they're also going to be about allowing a lot more of an ecosystem of SMEs and other startup around them, and not stifling them in ways that going to be more fitting with this dual transformation shaking the global economy. So that's really in a nutshell what I want you to take away, which is there's a big catalyst, there's this big change on the that is related to the end of oil and gas. But to get there, to get at that transformation, to get at that behavioral change that's gonna allow the GCC to really decarbonize and digitalize and be powerhouses of that, governance system shift are necessary, and they're subtle and context specific. So let me now try also to, staying at the high level, try to persuade you that when thinking about diversification or transformation, one really needs to think, in the context of a global economy that's transforming. We all know about the post-COVID, or during COVID, and then the post-COVID is certainly going to be a lot about that. Is this acceleration of the dual transformation, decarbonization, where, as I mentioned, the COP26 is ending, and there is an alignment of states, corporations about these net zero goals. There is also a strong bound between the two major powers, China and the US, over this net zero goal. Not that they are not going to compete over the dominance of the green industry, but at least there is such entente, such agreement that this is the direction of travel. On digitalization, things are more complicated. There is indeed the ascent of technology all around us. But there, the two major powers are really in a fierce rivalry, and we saw that in the different episode of the Huawei arrest of the senior manager of the company, the number two. So really, we are in a world that's transforming technologically. The two new technological revolution are this decarbonization and digitalization. But this is happening in a context where we have also a world order that has really changed, and where US and China are really going head to head, and in the middle there is the European Union. But really the two rivals are China and the US, and they're going to shape this transformation. And it seems what's emerging, if I want to make a prediction, is really a kind of co-competition, if you wish, an entente on the climate, on the decarbonization front, but much more rivalry, much more tension on the digitalization front. The question then becomes, what happened to the global south? What happened to others? And there, clearly, there are going to be winners and losers. The losers, again, with some uncertainty over the delay, where we will see the end of oil and gas, but some certainty around it as to that's gonna end. But clearly, the winners are going to be the developing world, the exporter of these minerals, cobalt and other materials that are essential for batteries and other inputs, equipment that are going to power this decarbonization and digitalization. So among the commodity exporters, there's going to be this kind of musical chair, if you wish, in terms of who wins and who loses. But of course, this is really creating an enormous tension, and that's why we're gathered to discuss. Is that there is this catalyst of this end of oil and the risk of stranded assets. I'm personally persuaded that China and India would not necessarily look away from the oil of the Middle East. They're certainly going to use it as much as they can, but there's going to be an end to that. And of course, this transformation, this decarbonization require a lot of financing to transform the energy sectors. And developing countries are currently battling over a facility that would help finance that. So fast forward, the big question is really how countries in the developing world are going to navigate this technological transformation that are decarbonization and digitalization. What is the right policy mix? And I'm going to try and zoom on the GCC as well. So to summarize, one could argue that the last 100 years were about oil and gas, and we see here the valuation in 2008, the valuation of oil company, those which were listed, but also those that are not listed at valuation, like Aramco, in the neighborhood of 900 billion. So until then, we had the world of oil and gas dominating the world economy. In 2018, clearly digital platform have emerged with the biggest valuation, and this is in the course of the last 10, 20 years. So impressive transformation, and the question is really what happened to countries that are on the margin of this transformation? How do they get in? And this is an important question for the GCC because until recently they have relied on the world economy, organized and dependent on oil. So as this demand shift away and the structure of the global economy shift away from oil, strategically, it's important to ask the question of how do we get on that bandwagon of decarbonization and digitalization, and find new comparative advantage and harness the potential of their talent as well. So some computation over the stranded asset. We have here over 50% of oil remaining underground. For the Middle East, it's 40% for oil, 60% for natural gas. So this is the big risk. At the horizon of 2030, most car manufacturers are committing to produce mostly electric vehicles. This is a big tectonic shift also for the oil sector, because transportation is a big chunk of the demand. So all points to a near end of the oil sector. At the same time, as you know, the region is endowed with large solar irrigation, so large potential, so an asset to be able to take that decarbonization trend forward. And if I look at the history of the debate on economic diversification for decades, this has been mostly empty rhetorics, if you wish. We've been talking about diversification, but not much has happened. There are some very limited successes, including in the region with Dubai. But clearly, when you look at the data, there's very little that has happened. interestingly, since the drop in the oil price in 2014, many GCC countries have embarked in new ambitious programs to transform their economy. And these programs appear somewhat having the right goals and are strategic, but they also somewhat are more of the same, since they are picking sectors and sometimes strategic sectors. But what we and I'm going to try and worry about here is not necessarily, we know the direction of travel is decarbonization and digitalization, but the issue I think we need to all point our finger at is really the way to get there, not necessarily just pointing at the direction. So this is some data on the evolution of manufacturing for the GCC. It's clearly flat over the last decades, so limited structural transformation. And I must say, before I go into this governance angle and the behavioral aspect of transformation, I also wanted to go back to some basic ways in which we've looked at diversification, which I think is also pointing to successes of the GCC in some area, which is that many of these programs, the old one and the new one, are really underpinned by investment funds, development banks. So there's really a realization that, of course, the financing of this program is essential. But of course, it's not just going to be about throwing money at the problem. And these new technological changes are going to make this much more complicated than when it's the case of oil and gas, and we'll come back to that. But clearly, sovereign wealth funds have been in existence for a long time for some of them, and they have served, I think, the GCC well in some area, including this first functional way we have of thinking about diversification, which is the strategic asset allocation of financial assets. So there we know of many sovereign wealth funds that have been run well, that are arm lengths from the rest of the government, that are run with a proper governance KPI and highest standard of managing risk and returns. Then when we compare, so GCC is done fairly well on this front. The Saudis have come pretty late to this, but very aggressively on setting up the PF. And the second functional way in which we've thought about diversification is the real asset, if you wish, dimension. And there, the objectives are, they're not as clear as in the financial asset objective, if you wish. There is a bit of social, technological transfer. So there, it's more about investing in private equity, and people who know about private equity know that it's more difficult. It's less transparent, somewhat. Even so, there are great opportunities. But when it came to domestic real asset allocation, this is done or was done through national development banks, and it's not specific to the GCC, but the development bank have also tended to follow standard. But when they're at the national level, the governance has been somewhat weaker and certainly less at arm's length than the traditional sovereign wealth fund dealing with investment abroad in treasury bills and other stocks. So the objectives are more shallow. They are mixing social and private return, and dealing with trying to achieve higher social return is great. But then when it's a national development bank, there is also issues related to cronyism and other aspects, which makes achieving this objective more difficult. So this tool of national development bank are, on the face of it, great, but I think they are much more difficult to operate, and the standards there are not necessarily where they should be. And then, of course, the other functional way we've been thinking about diversification was this macro stabilization goal, with kind of helping smooth the business cycle, inject liquidity in downturn, and withdraw during upturn. The difficulty there, and it's a more technical point, is that it's hard to target non-oil GDP when the non-oil GDP is heavily influenced by the fiscal policy and so there's an element of circularity between trying to smooth the non-oil GDP cycle, if you wish, and in order also to underpin that diversification, if you wish, because the economy is so oil dependent that fiscal policy responds to this. So if you then use fiscal policy to tame non-oil GDP, you get a bit in a bind. So one also need to maybe spend a bit of time in terms of what's the appropriate exchange rate, what's the appropriate macro-prudential rules for oil producing countries in thinking about stabilization. So with that said, let me now move to this trying to open up the discussion on what's the right, given this catalyst of the end of oil, how do we think about renewed governance that get us to the direction and to the end goal of achieving decarbonization and digitalization? And so there, I would argue that the traditional approach has been, vertical type of policy, top-down diversification. So of course, as I mentioned, the oil and gas sector is really truly an island sector, heavily intensive on capital, physical capital. And so early on, it was really important to invest in the technology to really be the champion of the oil and gas sector. And then once you had that, if you were to invest properly, then things were okay. Now, in thinking about this new technological trend of decarbonization and digitalization, one really needs to challenge the view that, of course, they're also requiring physical investment in infrastructure, but they also require, human capital a lot more, especially when it comes to digitalization and the economy around it, and perhaps they're more governance intensive in many respects, because they're not this kind of island economy. They're really about network externality. So one need to really challenge the way we thought about how we succeeded in terms of developing the oil and gas sector, and think of how governance intensive and perhaps also people talent intensive these new sector are. We often hear about the importance of this startup, and I'm going to give some examples of how the startup are essential for decarbonization, and of course all these big platforms we are talking about that have the biggest valuation globally have started this way. So really, I hear many friends in the GCC telling me that they are looking for the next big startup idea, and clearly that's unlikely to come from a big capital-intensive SOE. It's going to really be about the ecosystem of startup SMEs, and I know we've discussed that today. And of course, there's also the reason for rebalancing and putting up a more bottom-up approach, if you wish, is going to be also the jobs agenda. So really transformation, not diversification, because we really want that direction of travel to be about behavioral change, and that's gonna be the way we solve how to get there. So it's really gonna be a bit about talent and changing attitude, and this can only be underpinned by adhering not just to the letter, but also to the spirit of major governance changes. This is data from Hofstede Insight. which basically give a sense of differences in attitude when comparing, say, Kuwait, Saudi Arabia, in terms of individualism, power distance, all elements that are critical in powering innovation. And clearly we see big differences when it comes to these traits, behavioral traits that are important, and they are not inherent to Arab countries or GCC countries. They are about the fact that we had a period of dependency to oil. And as I mentioned, oil was more of an island economy, and then there was this social contract whereby people were getting paid and receiving this rent indirectly through public sector jobs, and that has shaped some of the behavioral trade. And the way forward is really to pay attention to how we get to change these behavioral aspect with the appropriate shift in governance structure. And when it comes to also state-owned enterprises and big oil sector, but also more generally, clearly the oil exporting countries, here Saudi, Qatar, and others, have really been lagging behind when it comes to spending in R&D. Even so, this happened in the oil and gas sector somewhat. We are at the end of the, if you wish, the technological wave of oil and gas. We're starting a new one. So investment in adapting these new technological trends is going to be critical. So traditionally, in addition to this behavioral threat that we are not prone to this more innovative type of economy, we also have invested less in R&D, and of course that goes together. So necessity is the mother of transformation, and as I mentioned here, we have a case in point. The end of oil and gas is programmed. It's going to happen. It may happen in 10, 20 years, but that's going to happen. That's the direction of travel. The major powers are agreeing to that. So this might be the last oil price super cycle. Investment in the sector is down. So oil price may stay high, but eventually oil and gas will be displaced. And we've seen that with the trend in terms of the cost of renewables. So really that's the catalyst. But what we need is, again, put the governance structure shift that organize the way to get there. And there, let's start with the structure, the corporate structure, the market structure of the GCC economy. And what's fundamental there is, of course, that the state-owned enterprises are at the center, and rightly so, because this was capital intensive. It was island type of economy. So, that's an inheritance from the past. Now that this major catalyst is happening, how do we think about opening up this governance? How do we think about accompanying this SOE to get into renewable more and do that in a way that is not wasteful and that's really innovative. So there are basic, of course, principle of best practices in terms of how one separates managerial delegation to manager by separating control from management, and really there what we see in many countries is that there's really on paper there is this notion that companies adhere to the letter, but the spirit is of the law, if you wish, is not something that has really as yet percolated. And so one needs to really think through these ownership aspect, the governance structure, the empowerment of manager, and transparency is going to play a key role. So the question becomes, strategically, since the end of oil is programmed, for a long time, the Middle East oil has been, has been nationalized. It has been, and rightly so. After independence, it was right for these countries to ascertain their sovereignty and use their resources at their own will. The question now is, isn't it now more strategic, given the program end of oil and gas, to amorph a change toward the decarbonization, to think about ways in which, instead of investing the precious dollars into pumping oil and isn't that a good time to invite more other companies that do not have the kind of reserve that the relatively cheaper reserve to extract of the Middle East, to invite them to use their their capital, their know-how to be more into the capital of this company, but help transform it. So as a way to really project into corporate governance that is more open, but that at the same time allow that innovativeness that say Exxon and others have shown in also getting into that new era of decarbonization. So really, a question to ask ourselves is, to what extent is this Aramco IPO signal a big shift in the region in terms of using IPO to really try and transform these big state-owned enterprises and transform them deeply in terms of being publicly listed, in terms of being much more accountable to their shareholder and stakeholder as well, and enhance their performance and their innovation. We've seen evidence from several academic papers on how IPOs in different parts of the world, including Asia and Latin America, have been followed by a lot more R&D investment and patents. So they're really about, these IPO are really about also about picking the stock market where you're going to be listing. And of course, there are different disclosure rules. If you list in Hong Kong or Japan, it won't be the same disclosure rule as in New York or London. So there are several aspects to how you tie your hand to a new governance structure and how binding this becomes. So as the decarbonization trend amplify, it is natural to me to think of the Western corporations that have perhaps on the intangible capital path, they have a better ability to transform, to join forces and become a big champion of renewable energy and other aspects. Doing it with your own resources would be, and developing the know-how is appropriate, but given how traditionally the governance has been, very top-down, it might be useful to mix it up. Now I'm going also toward another example that is connecting decarbonization with digitalization. Is the example of the Italian utility giant Enel, which is deemed the Google of energy. So the same way as Exxon and others have really thought themselves as not just an oil company, oil and gas, but rather now energy groups, diversified in many respects. And note that the importance of intangible capital, which is shaped by the governance there as well. The CEO of Enel has really embarked in the last 20 years, embark Enel in a big transformation, exploiting digital meters and the information coming from that to really evolve from just the provider of electricity to really the Google of energy, where you know the information about the consumer, you serve, you develop services that go well beyond just the provision of electricity. And to a large extent, given the potential for solar of the region, given the resources that the region, the DCC has, potentially this is also an avenue where partnering with this big giant could be the right direction of travel. So to end, I'll repeat my main takeaway. The world is really experiencing big transformation in terms of digitalization and decarbonization. The end of oil and gas is preordained. This is a catalyst for change, but that's necessary, but not sufficient. And to a large extent, reflecting on the corporate governance of SOE, but also, and I haven't spoken at length about that, but also about the larger issues related to competition and to the economy-wide governance in order to foster an ecosystem of startup would be necessary to amorce that transformation and get to that new direction of travel. I'll stop here and thank you very much.
Thank you very much, Rabah, for, a kind of a different view on economic transformation from a different angle. That gives us also some food for thought for the late afternoon and also the evening. Thank you very much. Thank you to all the speakers and to our hosts. I will close the conference for today and we will resume here tomorrow morning. Thank you very much. At 9:30, exactly.